Yeah, so good evening, everyone. Welcome you all on second day of GST Relearn series, the second series, which we can say last we got a really very good response, and we come up with the second series. And today we have with us WRC chairman, very dynamic, energetic, young Arpit Kabra sir with us, speaker of today's first half sessions, Amit Bothra sir and Chirayu Dodhia. So I welcome you all on the at the platform of WIRC. So before moving further, I would request to our chairman WRC, please address to the participants. We just wanted to know your idea.
Hello everyone, good evening. Thank you Shweta madam for setting it up. Welcome Amit ji. Chirayu, thanks for being there, and Bhavna and Umang, thank you for being around. Friends, we spoke about it. These are sectoral series that we've launched. What we want to do is we want to bring all of you on speed so that we could do some really good sessions, interplay of GST, interplay of different acts, different laws, and therefore sector wise also if we could do some specialization. So I think all of this is being done. It's a refresh, it's a relearn series, and therefore the only idea and the larger idea is to reach out to all of us so that we can come back, get into the halls, get into networking zone, and more importantly the learning space as well. While I talk about networking zone, I'm happy to share that we've started a networking zone. We've got a wonderful response, and I think a lot of synergies is what we try and intend to create. So our newsletters are now loaded with a lot of if I were to say really features, because one, it is now revamped. Second, it is easy to maneuver, and third, you can find out things in a much better perspective with a good interface also. So networking zone is one of these new ideas that we've created. If any of you wishes to reach out for any requirement, for any say a partner or a resource, or more importantly a network, I think all of you can do from this. In fact, there are already 20 plus line items that have been listed. So you can reach out, look at the current newsletter, see if any of you can fit in any of these things and you want to explore. You can please call up these people. Their contact numbers are mentioned here, and perhaps you can take it from there. So that's the entire idea, that what we want to do is set this up so that we could create a bridge and where somewhere try and aggregate resources. Since I talk about resources, WIRC is keen to conduct some series on automation. I think Shweta madam is driving that series for us under the DAB committee. What we want to do is we are looking out for people who can do data analytics, who can talk about power automation, who can talk about power query, who can also ensure automation for CA offices, small and medium enterprise offices. So if you know anyone, or if you have heard someone, or if you want to refer someone, let us know. We want to curate an entire series which would help SMEs adopt automation in their offices. I think these are the larger messages that we want to send across. Tomorrow, let me tell all of you that it's an interesting thing that we would be celebrating the Accounting Standards Day. That was the day when the ASB was set up in ICI. And again, as I said, we are entering the 75th year of our existence. So everything that we've done, it's a glorious sessions. It's a glorious celebration of everything that we've been doing for so many years in this wonderful country. So please, look forward for some important sessions on accounting standards, or if at all you can take out time, try and read one accounting standard, or maybe see a case study that may do justice to celebrating the Accounting Standards Day in our offices, in our own as an individual, as a chartered accountant. With these words, thank you once again for joining in. Have a great learning session. Over to you, Shweta ma'am.
Thank you, Chairman sir, for letting us know about the new updates. And I really must say that members are really appreciating networking zone, and with the new newsletters. Really, thank you so much. So moving further, I would like to introduce our speakers, Amit Bothra and Chirayu Dodhia sir. Amit ji is a partner at EY in the tax and regulatory services in direct taxation. And he has more than 18 plus year of experience, very rich experience in advising to MNCs, also litigation, due diligence, and etc. He has assisted client across industries such as banking, NBFCs, insurance broker, ATM manufacturers, financial intermediary and advisors, telecommunication, data centers, IT, and traders, firms, and etc. He has assisted one of the largest PSU bank during their demerger, and also a very regular speaker in industry and trade forums at professional bodies. So with these brief introduction, once again, I welcome you, Amit ji, at the platform of WRC. Really, thank you so much for accepting our invitation.
Thank you so much.
Chirayu, he is a manager at EY in the tax and regulatory services in direct taxation and has more than 8 years of experience in handling routine compliances, reconciliation, and transitional issues for clients in IT space, financial service sectors, also involved in advising setup of units at GIFT, and also a captive IT, ITS units, back office setup, settlement network, or on indirect tax matters. He has extensive experience in serving clients in banking sector, large PSUs, private banks, and foreign banks. Also serving clients in telecommunication, data center space. So with this brief introduction, I welcome Chirayu at the platform of WRC. Thank you so much for accepting our invitation. So without taking much time, I hand over charge to the Amit ji for the session. Thank you.
Thank you so much. Thank you, WIRC. Thank you to our dynamic chairman, Mr. Arpit ji, Shweta ji, Bhavna ji. Special thanks to Gautam Lal ji, who asked us to take this refresh session. I love the concept of what the WIRC is doing. While you read one Bhagavad Gita, there are different messages coming from the Bhagavad Gita. Same for GST. This is one law, but when you apply this for different sectors, you see the brilliance of what the law is and how it applies to various sectors. Today, when you do a relearn on media and entertainment in the second part of the session today, you will see how the same law applies differentially to different sectors. So I think it's a brilliant concept, and kudos to WIRC for organizing this. Relearn and refresh means we get to reconnect with you. COVID times are of the past, but I wish part 3 will be like a physical connect. We are raring to meet you guys in person and take this forward. Today, what we have organized is we will take you through the overview of the IT ITS sector, like I think we did the last time. Since then and now, the sector has moved substantially ahead, leaps and bounds. Now, whether you talk about the Ministry of Electronics and Information Technology, or you talk about the adventures of the government around IT ITS, something that is interfacing users like you and me, Aadhaar or the UAI DI platform, NIC, even STPI for that matter. So these platforms are all under the umbrella of the MITI, and they are interfacing with our routine lives every day exponentially. Apart from taking an overview, we will get into some of the nuances of what GST interplays in the software and the IT sector. In there, the last part, which is part 1, we had focused on incentives in the sector, and the idea was that you as a chartered accountant, as a practitioner in the field, what are the opportunities available to you in the sector? Unlike any other traditional sectors, IT and software industry can have an interplay for all forms of professionals, whether small time, mid, or the large firms. So this is a sector which has a plenty of opportunity for us as professionals to perform, to give our best, and give the potential to our clients in the sector. We will be covering aspects around intermediary, exports, credits available in the sector, with the software technology park schemes, the SEZ scheme. There's a new foreign trade policy that was introduced from 1st April 2023. So all of this we will interface. I'm glad that I had a commitment issue today, and my colleague Chirayu readily agreed to fill in for me. So he's going to lead the entire session today, and without wasting much more time, I hand over the platform to Mr. Chirayu.
Thank you, sir. And thank you, Shweta ma'am. So, friends, we'll now quickly get into the session. We've got a good introduction from Chairman sir, Shweta ma'am, and Amit sir. So, friends, we're here to discuss in detail on IT and software industry. So, before we get into the GST nitty-gritties, let's just have a look at the overall IT sector in India. IT is one of the most shining sector of Indian industry right now. If you look at the statistics, they tell the story for themselves. In FY22, the sector itself has clocked in a revenue of $227 billion. And the significant portion of that is $178 billion has come from export revenue. India is one of the leading exporter right now when we talk about IT and ITES industries. Again, a significant contributor to our country's GDP. It's 7.4% that IT sector has alone contributed to the GDP of our nation in FY22. And the way the sector is growing right now, it is expected that by FY25, this sector alone will be a 10% contributor to GDP. That's no less than 1/10 of the entire economy. Similarly, the sector is also one of the biggest employer right now, having employed 5 million people. So that means we've already got a skilled workforce, a technically skilled force of 5 million in our country. So these are the broad statistics of IT/ITES industry. How the industry is shaped, how is it mapped along? I'll just take you through that. When we talk about IT and ITES industry, it's divided into two parts. One is IT and one is ITES. IT is basically that space where your information technology softwares are either created or they are offered as a separate product in itself. Whereas ITES is that space where information technology is used as an enabler for providing services. So it's not that the software is sold, services are sold by use of software. So if I cover IT space, the biggest subsector within IT is software development. India is a great factory of software development right now, with a lot of traditional softwares in the form of package softwares, enterprise solutions, or EIP solutions. All these have been developed in India and are being developed. But India is also a home to new age technologies like robotics process automation, artificial intelligence, blockchain. These are typically the terms that we are hearing now and then. These are all trendsetter terms, and India is one of the largest contributor to making innovations and developing new technology solutions around these new technology concepts. Similarly, India also has a very strong setup when research and development is concerned, where new and innovative solutions are being developed, offered globally, and typically a prototype is something that is created and it's globally then adopted and replicated by way of, say, patent or by way of royalty. Thirdly, the last type of service under IT is where you assist entities in managing their entire IT network, their server systems, their applications, their ERP. So these are typically the offerings that are covered under IT. When you look at ITES is more of easing out someone's operations or bringing in a lot of comfort using IT as a platform. So most of your business process outsourcing models, they fall under ITES. When I say BPOs, India is which is known as a backyard for BPOs, because we are leading market for opening BPOs. Most of the setups like call centers, your transaction processing, accounting processing, payroll, transcriptions, these all are typical BPO setups that India has been offering, and these all form part of our ITES setup. Definitely, the call centers lead in this category. India being the hub for call centers, or to some extent on-call support for customers, for technological queries, for requests from your vendors, suppliers. So there are many organizations who have set up their back office in India. That back office typically is a BPO, and they've also set up call centers. So this is the ITES side of it, and this whole of it is our Indian IT/ITES industry, which is a major contributor presently to our economic growth. So having said this, I thought it's more informative to also look at what are the drivers which are driving the growth and placing India as one of the most attractive hub for IT/ITES services. So the first and foremost factor that contributes to it is our competitive advantage. Like the population that we have, the benefit of that is we've got one of the largest skilled manpower workforce, which is the most essential requirement for delivering IT/ITES services. So India is way too beyond other markets in having a skilled workforce. In fact, presently, almost 16% of our total workforce is technically or technologically skilled. The expectation is by 2025, this 16% is going to grow by 9 times. And the workforce is going to become so technologically skilled that we'll be able to up our scale globally in offering IT services or ITES services from India. Again, the cost of labor in India is so attractive that it's affordable to open up a BPO in India or to hire designers, software developers in India, and to serve globally from India. So these are our primary advantages for being so attractive in getting this market space. Secondly, there's a huge demand globally for IT/ITES products. Our leading customer, the leading importer qua our services is US right now. Similarly, if you look at the leading market, when I say market, the leading business vertical that is opting for IT/ITES services is BFSI, banking, financial services, and insurance sector. And typically, both of these coupled together have created a strong demand for the services from India. Again, India has been successfully venturing into new markets like African countries, European countries, even Russia to some extent, and Far East as the emerging markets where India has been providing IT services as a new offering. Again, because of the strong demand, this is one of the most lucrative sector for investment. This sector itself has seen sizable FDIs in last couple of years, ranking as the second most invested sector when FDI is concerned. Because you have a concentrated investment, you have a strong demand, and you have a strong workforce. This all has resulted into wider footprint of IT players within India, and in need of growing the capabilities. Most of the players have opted out to spreading operations in tier 2 cities. Friends, COVID has basically changed the entire way the industry was working, the sector was operating, with more and more manpower wanting to work closer from their home, preferring to work either from home or in a flexible environment. The way the sector operates has changed. The preference has been shown of moving out towards tier 2 cities, tier 3 cities, whereby your office space is quite closer to the hometown or the home of their employee, and that has basically helped to increase the productivity, to retain important skill set within the organization. So if you look at the growth that the IT sector is looking at right now, the development or expansion is more in tier 2 cities, and with all these expansions, the requirement of your technological infrastructure has also gone up. So the demand on IT hardware has gone up. Similarly, the demand on data centers, power connectivity, high-speed internet, all has gone up. And this has contributed to the development not getting concentrated only on tier 1 cities, but development being spread across tier 2, tier 3 cities. Similarly, the global demand has pushed many of our large IT players to move their operations and expand them globally as well. So you've got firms like Wipro, Infosys, TCS, who have global footprint now. They've opened up offices in US, UK, Philippines. The logic that goes behind this expansion is they generally try to move with the sun. That is, they try to operate and serve a market whenever it's a daylight over there, so that there is no losing out on work when you compare that your delivery center is only in India and you may not be able to serve other countries because of time zone issues. So you've got IT firms expanding globally and having a global footprint. All this has been possible because IT sector has been a core sector for the government. It's been a focus sector. There has been record allocation in the budget for IT sector. In fact, several policies which have incentivized or which were promoted IT sector have been released, have been put in place. The most popular of these are the SEZ and STPI scheme, which has definitely promoted in our IT sector growing all these years. Similarly, under the earlier FTP, there was a CIS scheme, or if we look at the PLI scheme that has been brought in to incentivize IT hardware manufacturers. There are some 14 PLI applications which have already been cleared. So it clearly shows that IT is a focus sector for the government, and they are ready to go to an extent to support this sector because it's one of the greatest employer, and it has been successful in earning a good chunk of foreign exchange for the country. Having said this, we will now look at what are the basic GST implications on this sector, and then we will move on to analyze and understand that how all these different factors that we just discussed are having some or the other ripple effect from GST perspective. What are the controversies around that, or what are the difficulties that the industry is facing on account of global expansion, on account of having a very dynamic workforce, or how has the policy been supportive on all these fronts? So as we all know, IT and ITES services are liable to GST at the rate of 18%. There is no specific exemption that this service offering enjoys under the current GST legislation. So whatever services are provided domestically, these services will be liable to GST at the rate of 18%. And typically, a domestic service will be governed by Section 12 of IGST from place of supply perspective. And IT services will fall under the general rule under Section 12. So the place of supply will be basically the location of the service recipient in this case. So if a service is being provided, for example, by IT firm in Pune to a customer in Mumbai, these are going to be taxed at 18%, but CGST and SGST will be applicable since this will be an intrastate supply. Vis-a-vis same services being provided by an IT firm in Pune to someone in Delhi, this will become an interstate supply liable to IGST at 18%. Now, when these services are provided to a SEZ unit or a SEZ developer, these services are treated as zero rated. Section 16 of IGST Act provides zero rating benefit to services that have been provided to a SEZ unit and developer. Again, it will be important to see if these services qualify as towards authorized operations of the SEZ unit. So at this point, it is important to note that there is a default list of services that has to be referred for SEZ units, which has been basically prescribed by the Ministry of Commerce, and IT services and ITES services find their place in that default list. So whatever services are part of the default list are deemed to have been used towards authorized operations. So your IT and ITES services, if provided to a SEZ unit or developer, will enjoy zero rating benefit. When it becomes zero rated, there is no requirement to charge GST on that. This is the simple mechanics in case of a domestic supply of service. Now, because of the global footprint and a strong market overseas, more IT firms are involved in cross-border supplies. Again, if I look at a cross-border supply, the place of supply for any service is to be determined based on Section 13. So under Section 13, there is no specific rule for IT, ITS services. Hence, we need to refer to General Rule 13.2. And General Rule suggests that this place of supply will be the location of service recipient. Now, in our case, if for example, say the supplier of services is from any IT park in Pune, providing services to an entity in US, because the customer is ultimately located outside India and the destination where the services are consumed is outside India, this should qualify as export of services. Once it qualifies as export of service, IGST Act Section 16 provides zero rating benefit on this. And the supplier, that's the exporter from India, will have two options. Either he can export services without paying GST and claim a refund of unutilized input tax credit that is there in his kitty, or he can export services with payment of IGST and then subsequently claim a refund of that tax that has been paid. Now, exception to this is under IGST Act, there is a concept of intermediary. We'll look at this concept in greater depth in the next slides. But if at all the supplier qualifies as an intermediary qua these IT, ITS services, the supplier will not be able to claim a export benefit on this supply. In fact, this supply of service will be liable to GST at 18%, and CGST and SGST would be applicable on the same. Both these concepts, exports and intermediary, we will look into it in greater detail in the next slides. But I hope at this stage, we all are clear how the taxability, place of supply, and zero rating benefits work for a IT, ITS sector. So, moving to export of services, Section 2, subsection 6 provides a definition for us on how a service can qualify as export of service. There are these conditions which have been described. First one being the supplier of service should be located in India. The recipient of service should be outside India. The place of supply, that's the place where the legislation deems the services to have been consumed, should also be outside India. The payment for such services, that's the consideration for such services, should have been received in convertible foreign exchange or in any other mode that is approved by RBI. And the last one being that the supplier and the recipient should not be merely establishments of a distinct person. When we say establishments of a distinct person, under GST law, a branch and an HO have been basically defined as establishment of a distinct person, or a branch and a branch office is treated as a distinct person. So it cannot be a case that, say, a branch office in India is providing services to an HO overseas. Those kind of services will not qualify as export. Still, you will have the option of exploring whether these services will get categorized as exempt under exemption notification. Now, once these conditions for exports have been met, typically you get an option of calling this out as a zero rated supply. Like I mentioned previously, the supplier will have an option either to export without payment of tax or to export with payment of tax. Under either case, the supplier will have an option to file a refund claim, where the supplier wants to opt for exporting services without payment of tax, he will be required to file something called as a letter of undertaking before the start of a financial year. So once you file this letter of undertaking online on GSTN portal, you become eligible to claim zero rating benefit on all your eligible exports, and you become eligible to export these services without payment of tax. Now, when these services have been exported without payment of tax, there is an additional condition that has been cast upon the exporter, that the consideration that is supposed to be recovered in convertible foreign exchange, that is required to be realized within 1 year from the date of invoice. So say, for example, I have exported services, say, to a customer in US, and I have an invoice dated 1st April 2023. I am bound to recover the consideration against that invoice within 1 year, that's within 31st March 2024. If I fail to do so, I am required to discharge tax on this invoice. That's the IGST component, which was earlier zero rated for me. The tax amount along with interest, and that interest would be applicable since the day of invoice till the day I complete 1 year of not having collected this revenue. So while there is a zero rating benefit that has been provided to exporters, that benefit comes with some conditions which need to be complied with, and the necessary compliances have to be fulfilled so that you are able to safeguard your zero rating benefit. Now, in the same breath, I want to cover this one more point, that if you look at the conditions for export of services, one of the conditions is place of supply should be outside India. Now, this is where your intermediary concept comes into play. As per the definition of intermediary and the place of supply provisions, in a cross-border transaction, the place of supply, the destination where intermediary services are deemed to have been consumed, have been prescribed as the location of supplier himself. So your place of supply in case of intermediary becomes the same place from where the supply has been made. So it fails to come to a situation where your place of supply is outside India if you are providing intermediary services from India. So in that case, your export conditions are not fulfilled, and the supplier of such intermediary services will not be able to claim the export benefit, and in fact will end up being subjected to GST at 18%. Yes. We will look at the intermediary concept in greater detail over here. The definition of intermediary is like intermediary means a broker, agent, or any other person by whatever name called, who arranges or facilitates the supply of goods, services, or both, or securities between two or more persons, but does not include a person who supplies such goods or services or both, or securities on his own account. Now, if we look at this definition, it covers two parts. One is it involves a person who is basically engaged in arranging or facilitating a supply of services. What we understand from this is it typically includes a person who does not provide the services himself, but who is arranging or facilitating supply of services between two or more persons. And the second part is a very correspondingly relevant exclusion, which says a person who's providing services on his own account will not qualify as intermediary. So in a very simple example, say you have a sales agent who is scouting sales orders for you, is basically engaged in arranging supplies between yourself and your customers, and he will qualify as an intermediary, because at the end of the day he is not going to supply the commodities on his own account, but he is going to arrange the supply of commodity from yourself to your customer. That's a plain vanilla example of intermediary. Now, how intermediary becomes relevant to IT/ITS industry. This concept is not a new concept. This was there under service tax as well. And since service tax days, the department has been of the opinion that whenever there is an involvement of three parties in a typical setup of ITES services, it qualifies as intermediary. This has been the simple logic that the department has always applied. However, if you look at it, the kind of arrangements that they have held as intermediary are some like these. That if, for example, you are operating a call center in India, it's a back office call center. Say, for example, you are operating a call center for any foreign bank in India. The customer of that foreign bank, who is based out of, say, for example, London, he dials in to you. He dials on a number and the call at the back end reaches to the call center in India, and the executive sitting over here basically answers and resolves the queries of the customer. Now, this call center is a back office. It's a ITES back office, which is providing services to the foreign bank. And in the course of providing these services, the call center is to some extent interacting with the customers of the foreign bank. The department has very categorically called it out as an intermediary, having held that the call center is arranging services between the foreign bank and its customers. Now, if you look at the intermediary concept, it's much wider than that. It does not involve mere back office operations on behalf of your customer as intermediary. You can become intermediary only if you are arranging or you are facilitating a supply between two persons. You cannot become an intermediary if you are providing your own services. So in our example, the call center per se was providing its own services, ITES services to the bank. And in that course, it was required to interact with the customers of the foreign bank. However, in the course of providing their services, they were nowhere arranging or facilitating any sort of services between the foreign bank and their customer. So this is a pure example where the supplier could have qualified as exporter, but department has gone ahead and called it out as intermediary only because there were three parties involved operationally, not contractually, but operationally. And it was assumed that the Indian ITES back office was arranging or facilitating services. Now, this has created a lot of controversy under service tax, also under GST, with several players losing on their zero rating status and in fact losing out on the eligible refunds of GST, coupled with tax demands on their output service, calling it as intermediary. And hence, after a lot of representations from the industry, CBIC came out with a clarificatory circular in 2021, clarifying on how intermediary services are to be analyzed and evaluated. What constitutes an intermediary service, what does not constitute an intermediary service. And this was a much required clarification so that a pan-India circular from CBIC helps us to get equalized treatment before all the jurisdictions in the country, and so that your tax authorities, your state tax authorities, central tax authorities, both are aligned and both have a central guidance on how do you look at a typical IT or ITES setup and what kind of arrangements are intermediary, what are not intermediary, and how export status is to be given to the exporters and how refund claims are to be evaluated. So if you look at the circular has typically laid down that what are the prerequisites for an intermediary arrangement to exist. First and foremost being there have to be minimum three parties. When I say three parties, there is the main supplier, a main customer, and then there is a third person who is facilitating or arranging a supply between these both entities. Now, when you have minimum three parties involved, it also necessarily has to be two different distinct supplies. One is the main supply that is being arranged for. So in our vanilla example that we had, you have a goods trader, you have a sales agent, and you have a prospective customer. The sales agent is scouting for the prospective customer for the trader. So when this sale deal happens, the sale of commodities from the stock trader to the customer will be the main supply, and the sales agent will earn a commission for the agency services that is provided to the stock trader. That will be the ancillary service, and that service will be called as intermediary service. Thirdly, it has to be a person in the nature of an agent or broker or any other name, but someone who is an intermediary in a transaction, someone who is basically enabling a transaction to happen. It cannot be someone who is not an enabler of the transaction, but someone who is supporting the transaction at backend. A person who is supporting a transaction at backend, maybe a subcontractor, maybe an outsourcing guy. So he might not qualify as intermediary because he is not involved in making sure that the supply happens between two persons. He may be supporting the supplier at backend, but is not involved in arranging or facilitating the supply. And lastly, like I mentioned, someone who is providing services on their own account will not qualify as intermediary. So if in our example, if the sales commission, if the commission agent tomorrow starts trading in goods himself, so when he sells goods, he will not remain an intermediary, then he will himself become a supplier because he's supplying goods on his own account. He will no more remain an intermediary because now he started buying goods on his own account and then selling it onward on his own account. So there is a thin line of difference between someone providing service on his own account and someone providing or arranging services. But this distinction is very important so as to categorize who is an intermediary, who is not an intermediary. The circular has been helpful enough to also come up with few illustrations, and most of these illustrations are very relevant from IT and ITS perspective. We will cover these illustrations in the next slide, but the first illustration is nothing but the example that we discussed of a sales commission agent, and the circular clearly brings out this arrangement as an intermediary. Yes, so these are the illustrations that have been provided in the circular. First one is a selling agent, where just like we mentioned, an entity is involved in scouting customers for a supplier, and the entity charges a commission for every sale that is made. So in this case, the agent will definitely qualify as an intermediary. Similarly, you might also have a procurement agent, someone who is arranging for supplies, someone who is arranging your procurements and scouting potential suppliers for your business. Such a person will also qualify as an intermediary. The other distinctive illustrations that have been provided in the circular is a typical example of subcontract. Say, for example, there is entity A, which is involved in offering customized software solutions. Entity A is engaged by a customer B for providing a customized software basis their specifications. At backend, entity A subcontracts or outsources a part of its job to entity C for coming up with the design and development of the particular module which has been sought by entity B, the customer B. Now, in the course of providing its services, the subcontractor C is required to interact with the customer B to understand their specifications or to understand the exact expectation of the outcome of this entire process. In this case, the circular is clearly head out that C is not engaged in any sort of arrangement or facilitation of services between company A and the customer B. C is providing IT services on its own account as per the specifications which have been laid out, And for C, the customer is company A. It is not involved in any sort of sale of services from A to customer B. It is only operating as a subcontractor, executing the task as instructed and as specified by the main contractor. So C will not qualify as an intermediary in this case. Similarly, there is another illustration of outsourcing arrangement. Now, this outsourcing is very much similar for our ITS framework, where you typically have a BPO open in India, where the customers of your customer, they dial in for any sort of queries, for any sort of after sales feedback, and the call center, the BPO basically caters to all your customers over call. Even in this case, the circular has clearly brought out that this is not an intermediary setup, because the call center or the BPO is not engaged in any sort of arrangement or facilitation of services between the customer and his customer. They are only providing back office BPO services by catering to your customer demands and addressing their queries. They are not executing any sales on your behalf. They are not marketing your products. In fact, they are not going out and obtaining sales order for you. So a typical call center, a back office in India, all these have been clearly covered in this circular, and this is a very, very positive circular helping the industry in resolving issues where authorities have held ITS services being provided from India as intermediary and sought to demand tax on it. I would like to now cover a very recent ruling of Delhi High Court, again involving the controversy of intermediary. This is for a very well-known firm, Ernst & Young, where Ernst & Young UK had entered into agreements with their group entities globally, say EY, US, Australia, Singapore, where they had agreed to provide professional consultancy services through the branch office that EY UK had opened in India. The branch office was serving all the group entities directly, and it was invoicing these entities directly on arm's length basis and claiming zero rating benefit on this. However, when a refund claim was filed, the department sought to reject the refund claim, citing that what the Indian branch is doing is nothing but operating as an intermediary on behalf of the HO and arranging for the services from the HO that is in UK with all other group entities across the globe. Now, when the matter reached Delhi High Court, a very, very recent, very detailed order has been issued by the High Court, taking into consideration the facts and how the legal framework is. The court has critically evaluated the definition of intermediary, and they have held that it is very clear that only someone who arranges or facilitates services between two persons can qualify as intermediary. Even if someone is providing services on his own account or on providing service on behalf of someone, that cannot be called as intermediary. In our case, in the case that we are dealing with, the Indian branch of the company was providing services directly to the group entities who were their customers in this case. Now, there was no involvement of the HO. The services were being directly provided from India and consumed by the overseas customers. Invoice was being issued directly to the customer, and the collection was being made by the Indian branch office, which was the supplier in this case. Even if someone is to hold out that the Indian branch office was providing services on behalf of the HO, the branch office is still providing services on principal to principal basis. It is not arranging for services between two persons. It is not a case where the branch office was getting the HO or getting the HO to provide services to the customers and only claiming the value addition limited to getting two parties to deal in a contract. It was not a case that like that. It was in fact a case where the Indian branch was providing services on its own account and it was recovering consideration on its own account. So you cannot call this setup as an intermediary. In fact, the court went on to say that the focus on the last limb of the definition, which excludes a person who makes this supply on his own account, that last limb of the definition is not the controlling part of the definition. It's only a restrictive phrase which basically closes the loop and excludes any person who provides these services on his own account. But merely because it says someone on its own account does not mean a situation like where you are providing services on behalf of your customer becomes an intermediary. The focus of the definition continues to remain on the first limb, which clearly says that it has to be someone who arranges or facilitates a supply. It cannot be someone who is in fact engaged in making the supply in its own. And taking basis of the circular of CBIC, where the outsourcing arrangement was already included as an illustration, the Delhi High Court has blessed this circular and confirmed the view. And in fact, in the typical case of EY UK, the Indian branch of EY UK, they have held it out to be an export of service and not an intermediary. And the zero rating benefit has been granted. In fact, a couple of days back, another ruling of Delhi High Court was also issued, basis the same ruling. And so it clearly brings out that courts have consistently followed this principle, and they agree to the argument that a typical outsourcing arrangement cannot be called to be an intermediary. At this juncture, I would like to also cover a very recent development at Bombay High Court, a petition that was filed recently by a petitioner, where the entire constitutional validity of intermediary as a concept under IGST was questioned. I'll briefly touch upon this. The controversy was typically that Section 13(8) of IGST Act, it prescribes the place of supply for intermediary as the location of the supplier. So in a way, it deems that the intermediary services have been consumed at the same place where the location of supplier is. Hence, you end up paying 18% GST, and this 18% is typically CGST and SGST because it becomes an intrastate supply. The controversy that the Delhi High Court was evaluating was that Section 13(8) is an IGST section, which due to which you end up taxing intermediary services in case of cross-border transactions. But the resultant tax levy is a CGST and SGST, which is not a levy under IGST Act, but a levy under CGST Act. It's the CGST Act and the State GST Act, which govern the tax on intrastate transactions. Now, CGST and Maharashtra State Government Act, Maharashtra GST Act do not find reference to intermediary as a concept, and they don't have provisions which can help you to tax an intermediary transaction. Vis-a-vis under IGST Act, in Section 7, subsection 5, any cross-border transaction has been deemed to be an interstate transaction. The controversy now emanates is that a cross-border transaction is an interstate transaction, but because of intermediary deeming fiction, this transaction is taxed as if an intrastate transaction. Hence, there is some friction within the provisions, and the provisions of CGST Act, Maharashtra State Government Act, and the IGST Act do not seem to be in sync vis-a-vis when taxing an intermediary transaction is concerned. And High Court has taken a note of this thing, and while holding out that intermediary taxing a transaction by calling it an intermediary is not unconstitutional, but definitely charging CGST, SGST on this transaction by calling it out as an intrastate transaction does not find a proper place in CGST Act. And the court has clearly brought out that the taxing provisions are not in sync between both the legislations. And hence, there needs to be some kind of parallel between both so that this transaction is brought to tax under correct head and as a correct nature of transaction. This is a very recent development, and definitely it's we should all look forward to see how this ruling is taken up at the next stage. How do the parties react to it? What is the next action that CBIC or GST Council takes up on this? But intermediary as a subject is something very interesting and something which is very, very engaging, both from industry perspective and department perspective. So this is a space that we all should be following and closely monitoring. So next thing that I want to cover is the whole aspect of how IT firms in India are expanding nationally throughout other states, and how are they managing this expansion from GST perspective. We all are aware that there is a concept called input service distributor. So any firm which holds more than one GST registration or holds a GST registration more than one state, there is a provision under law, a facility which helps you to distribute the input tax credit that you would have received on common input services. There can be many common input services that would have been procured for entity as a whole. Some basic examples are like your tax advisor services, the legal services, or the services of your IT consultant, services of your HR consultant, management consultants, or your IT service provider. These are typical support services which our organization procures at central level, and the benefit of this or the consumption of all these services happens throughout the organization. So large IT firms who have now grown beyond states have their setup across states. They have a facility of obtaining an input service distributor registration, and through this registration they have a facility to distribute the input tax credit on common input services. And there is a prescribed mechanism in law that this distribution will happen only to the recipient GST registrations who have benefited out of this common input services, and the distribution has to happen in the proportion of their respective turnovers. Now, the moot question that one needs to answer is obtaining an input service distributor registration mandatory, or it's only an optional mechanism to facilitate the trade? Now, the same question was posed before the council and before the board, and in the sectoral FAQs which were released for IT/ITES sector, they specifically have answered that obtaining an ISD registration is not mandatory. This is a facility that can be opted for if the assessee intends to distribute common input tax credit on common input services to its registrations, to its different registrations, but it is not a mandatory requirement. So ISD as a concept is a mechanism that has been provided in law. Secondly, the other thing that I want to discuss is the cross-charge mechanism. Now, what is happening is under GST law, the different registrations that a company would have obtained, maybe in the same state or in different states, these all are deemed to be distinct persons where a GST framework is concerned. So any supply that is being made between these states are treated to be taxable supplies. And that is the reason that the industry offers tax and cuts the invoice and reports when a stock transfer is done from one state to another. Now, cross-charge is typically done between distinct persons because of a deeming fiction that is created in Schedule 1. Schedule 1 to CGST Act deems that any supply that is made between distinct persons, supply of goods, services, or both, without any consideration, these will be treated, will be deemed to be taxable supplies, and basis the valuation mechanism, value should be derived and offered to tax. So in a typical setup of an IT company, most of the support functions like your HR team, legal team, your finance team, tax team, all these are typically centralized functions which operate from a back office or from the HO, and they cater to the needs of the entire organization. So their services are being benefited by the entity as a whole, including offices which are in another states. So the entity, the HO or the back office ends up providing a lot of support function to other offices of the same company which are situated in other states. Now, as per GST law, these support functions are deemed to be taxable supplies, and there is a mandate from law that these supplies should be valued and offered to tax. There are valuation mechanisms prescribed specifically for values between distinct persons. If I go in a sequential manner, the first preference is it should be the cross charge should be valued at open market value. If not open market value, the value should be of goods or service of like kind and nature. If not like kind and nature, it has to be at cost plus basis, cost plus 10%. And if nothing of this is available, you can derive a reasonable method. However, there's a relaxation that the law provides, that where the recipient of these support services is eligible to avail full ITC on this cross charge, any value that is considered for cross charge purpose is deemed to be the open market value. And this is purely because this is going to be a revenue neutral transaction for the government, because even if you derive open market value and charge tax on it, your recipient will be eligible to avail full ITC on that same amount. So a tax liability at one hand will have an equivalent tax credit at the other hand. So it's going to be a wash transaction for the government. So for cases where within the entity, different registrations are able to avail full ITC, whatever value you adopt for cross-charge should be acceptable to department. In a typical setup of IT or ITES industry, most of your entities will be fully taxable on outward side, and hence they will be eligible to avail full ITC on inward supplies and on intra-entity supplies like cross-charge. So the valuation should not be a problem. Now, what is to be looked at is ISD and cross-charge mutually exclusive, or they are alternatives to each other? There has been a lot of controversy around this. There are two different schools of thought, and let's clearly see what's the difference between a cross-charge and an ISD. Cross-charge in itself is a taxable supply which is being made, and this is a taxable supply because of a deeming fiction. Whereas when you do credit distribution to input service distributor registration, that distribution does not take the nature of a supply transaction. It's purely a mechanism. It's a funnel which you use to consolidate your common input credit on input services at one single point, and then you use that for distributing. So your distribution activity is not a supply transaction. It's purely a distribution formality, and it does not constitute a taxable supply in itself. So there is no taxable value or anything assigned to it. It's purely appropriation of tax credits to the recipient. Whereas for a cross charge, there is a taxable value on which tax is discharged, and it is reported in your GST returns as if a supply has been made. So this is the basic difference. Now, when you look at cross charge, the mandate to cross charge comes from the deeming fiction that is there under Schedule 1 of CGST Act. This mandate makes it compulsory for any entity to undertake cross-charge for any supplies which have been made intra-entity where no consideration is involved. So one can easily understand that cross-charge is mandatory irrespective of having opted for ISD, because cross-charge serves a different purpose and the requirement to do cross-charge comes from a mandate which is there in Schedule 1. Now, if you look at ISD, legislation does not put a mandate for any taxpayer to mandatorily obtain ISD registration for doing ISD distribution. It's only an optional facility which you may or may not opt based on your requirements. This has been clarified by CBIC in our ITITS FAQs, also in other sectoral FAQs. But lately, if you look at the view that department is adopting in several ARs or several assessments, is that department has held that ISD is the only mechanism that can be used for distributing input tax credit on common input services. There cannot be distribution of common input services or the credit on it through cross charge. They have held that ISD is the only mechanism and it's a mandatory mechanism, and without ISD, any entity cannot cross charge their common expenses within their group. Secondly, if at all the HO wants to cross charge other offices for the facilitation of the coordination work they have done, it cannot include the cost of input services, because the department is categorically held that HO is procuring common services only in the capacity of a pure agent. So if it's procuring in the capacity of a pure agent, it cannot then go ahead and charge other entities by way of a cross charge and do a distribution or appropriation of common expenses. Thirdly, department has also held recently in a AR in case of Profi Solutions that your cross charge cannot be limited to common expenses. It should also include salary cost of your employees at HO, by treating them as employees being employees of only the HO and providing services to other offices in other states in a representative format. So if you look at how department is interpreting is, they are treating every state registration as different offices or different entities in itself, and treating ISD mechanism as compulsory for distribution of input tax credit, and disregarding cross charge as cross charge being only for the value addition that the HO is doing. Now, this entire concept needs to be very closely looked at, because the mandate of both these mechanisms are different under law. For a cross charge, you will end up issuing a tax invoice. You will end up reporting that in GSTR1. If the IT firm is covered under e-invoicing, this cross charge invoice will get reported on GSTN for e-invoicing and then considered for 3B as a tax payment. Whereas for ISD, there's a separate set of returns, that is GSTR6, and that is separate returns for ISD. And similarly, you will have to cut an ISD invoice, which will not reported as a tax invoice, but only a distribution mechanism. So these are both different concepts, and one will have to clearly evaluate how both these mechanisms are to be implemented from the perspective of achieving fullest compliance to GST law, and also achieving compliance in the manner of distributing your common input tax credits correctly. Friends, while I am moving to the slides, I will also ask you guys to drop in questions in the Q&A box if there are any queries, or if you want us to specifically cover over here. We'll be more than happy to take up those questions if the time permits. Next thing is a concept that I wanted to cover. IT firms are growing huge in sizes, and because of the dynamic workforce that India has, there are a lot of people issues that the large IT firms generally deal with. Uh, Two of these I have covered over here, but there are a lot of transactions that happen between the employer and the employee. And under GST Act, the employer and employee are deemed to be related parties. So any transaction that happens between an employer and employer, the first and foremost point to be evaluated and assessed is that does that constitute a taxable transaction? If at all it constitutes a taxable transaction, is there a requirement to value that at arm's length as per the valuation provisions which have been prescribed under GST? There were two burning issues in the industry for which representations were filed, and we've got positive clarifications from government. I'll just cover both of these today. One is the taxability of perquisites which are paid to employees. Are they subject to GST? And if at all they are subject to GST, on what basis? If you look at the current framework of things, there are a lot of perquisites that the employer offers the employee. These are basically perquisites like gym facility, house help facility, in fact, vehicle that the employees provided. These all are paid over and above. These all are provided over and above basic salary, and it's to attract and retain a very important good skill set within your organization. The question was whether all these perquisites that are paid to the employee do these constitute a separate taxable supply in itself over and above the basic salary. So the CBIC has clarified that since the service of an employee to an employer, which is provided in the course of his employment, is any which is outside the purview of GST, thanks to section schedule 3 of CGST Act, any perquisite that is paid to employee by the employer as a part of the employment agreement or in the course of employment, all those perquisites will also remain outside the purview of GST. It will not constitute a separate taxable supply, and this will have the same nature as of salary, which is being paid to the employee. Salary currently is outside the purview of GST, and accordingly, any perquisite that is paid will also not be subjected to GST. This is a very positive clarification. Similarly, there is also an issue that there are a lot of employees switching firms for better opportunities. There's a lot of iteration in the IT industry. All these instances of employees leaving the organization generally trigger few contractual clauses that are agreed in the employment agreement. A few of these will be notice pay because the employee is not serving the agreed notice period, or recovery of a bond amount because the employee has left the organization before a mutually agreed minimum period. So the industry had always faced this controversy from department, when department had held that notice pay recovery or bond recovery is nothing but a consideration that the employer is earning for agreeing to tolerate the act of the employee leaving the organization before the agreed period or by not meeting the contractual terms as per the employment contract. This had a far-reaching impact because there were several other issues like liquidated damages, penalties for non-performance. These all fell in the same bucket where department was treating these as deemed services and calling it out as obligation of agreeing to tolerate an act. So last year, the CBIC came out with a very positive circular clarifying that for all these cases where on account of a contractual term not being met, there is a recovery that is being made. Those recoveries typically are in a nature of deterrence. When I say deterrent, is the employment contract would have mentioned that the employee is required to serve a minimum period of 1 year, and if he leaves before 1 year, there will be a bond recovery. So this deterrent clause is to dissuade the employee from leaving the organization before the minimum agreed period. It typically dissuades non-serious employees from taking up the job, or people who have taken up the job and the company would have made a lot of investments in training the skill set and bringing them to speed, and the employee is leaving the organization before before fulfilling his commitment of the time frame. So these kind of clauses are not considerations for tolerating an act, because by paying this amount, the employee is not going to receive anything in return. In fact, these are all in the nature of penalties. So one cannot call this as a consideration. In fact, it's a deterrent clause in the agreement which dissuades the employees from leaving the organization beforehand. And so CBIC has held that notice pay recovery or bond recovery, these are not considerations that should be subjected to tax. And in fact, these are non-taxable transactions. Kerala High Court has, in the recent petition filed by Manappuram Finance, confirmed this view, and in fact have extended the benefit of this circular retrospectively, and also agreed to grant a refund to Manappuram for whatever tax has been paid for the past period. So I will quickly cover one last topic that I want to cover is the policy support that ITS sector is receiving right now. Friends, last time we had covered the SEZ and STPI policy in detail. I just want to cover one small point, that's the work from home facility, which has been provided to SEZs specifically. As we all know, work from home is the need of our right now. Many IT firms are facing a lot of heat because of employee iterations, only because employees are being offered a far comfortable working environment, a far comfortable working framework by allowing work from home or working from a flexible environment. So keeping in mind the demand from the industry, SEZ authorities had introduced a fresh work from home mechanism which allowed 100% work from home for employees of a SEZ unit, vis-a-vis the earlier rule that was introduced in August 22, which allowed only 50%. This 100% work from home provision was a welcome change, and with this new rule, the entire process of applying for this scheme, this work from home benefit, has also been simplified. It gives a deemed approval up to 31st December for the existing units, and for new units also who are opening up offices right now, they need to apply for this scheme before launching the work from home facility for their employees. The application is simply in the form of an intimation email to your development commissioner. There is no need to attach a list of employees who are covered under the scheme. A simple email intimation makes you eligible to opt for this scheme for your employees. And the scheme is deemed to continue up to 31st December this year. And once you become part of this scheme under Rule 43A, your unit is allowed to move duty-free assets outside the unit for official purposes without payment of duty, with the condition that such movement would be allowed only up to 31st December. By that time, the duty-free assets have to be brought in. The only part where the industry should seek clarity is what happens after 31st December, because there is no guidance on the renewal of these approvals automatically after 31st December. Neither does the rule provide for any framework that will be applicable. So it will be important to look at do we fall back on the same policy which was applicable last year, where you had to monitor a 50% approval by way of maintaining employee logs, maintaining the logs of movement of assets, and strictly calling out as a 50% scheme and nothing beyond that. So that is something that the industry will have to closely monitor, that how does the scheme continue after 31st December 2023. I think we should now be good to open for questions. So I've got few questions before me, which have been posted by the participants. I'll just read out the question. It says, if a Mumbai-based software developer company allows a Dubai client to use a cloud-based software, whether it is an export. So it will be very important to look at what kind of software is being discussed over here. If it's a pure play software development that the Mumbai-based company is doing, and it is uploading the software or it's hosting the software on the cloud for now the users to use it, it will still qualify as an export of service. But if the software is in the nature where the customers are supposed to use that as a database for requesting data, for accessing data, it can still be classified as OIDAR. OIDAR is a separate concept which is online information database access and retrieval service. So if it's a software platform like your Netflix or say some other platform where you've hosted it on the cloud and your overseas customers are using it, you might still have to look at the provisions from OIDAR perspective. But if it's a pure software which is hosted over a cloud and your employees or your customers are using it, it will qualify as an export. Yeah. So the next question that I have is, proviso of Rule 28 talks about full input tax credit. What is the meaning of this? Particular services taxable and full ITC is available, or all the outward supply of assessee taxable means no exempt services. So if you look at Rule 28 and the proviso to it, it clearly says that the open market, the value that you adopt will be treated as the open market value if the recipient is eligible for full input tax credit. When we say full input tax credit, it has to be evaluated basis the output supplies that the organization is providing. So say for example, the HO in Maharashtra is doing some cross charge to your branch office in Hyderabad. So you will have to see if Hyderabad is sorry. You'll have to see if Hyderabad office is not providing any exempt or non-taxable supplies, and the entire output is being offered to tax. If that is so, then there is no reversal of ITC that is triggered on your input side. That means you can call yourself as being eligible to avail full ITC. If that is the case, your cross charge can be valued at may not be valued at open market value, but at a value which you determine, and then you should be able to avail full credit on that, and that value should be acceptable to department. I have got another question which says that the company has two registrations in two different states, and because of the contracts that are being executed, there's a requirement to send materials to the second state from the first state. And will this require a cross charge? This will definitely require a cross charge, because if at all any material is being procured, say by any one state, and then that material is being transferred to another state for conducting business or for executing contracts or onward supplying these materials as a part of your outward supply, then this is a typical transaction which is covered under Schedule 1 deeming fiction. In our trade parlance, we typically call this as a stock trade, where under the same deeming fiction of Schedule 1, this transfer of material as a stock item is offered to tax. Again, the principles remain the same, that if the recipient GST registration is eligible for full ITC, the value that you adopt for stock trade, just for stock transfer, should not be challenged. Yes. Another interesting question that we have is the HO is receiving a lot of common services. The benefit of that is definitely consumed by the entire organization, including registrations in different states. And HO is paying for these services, is receiving the invoice, and the entire credit is appearing in the 2B of the HO. Can the department disallow these credits partially because these are being consumed by another states? So if you look at section 16, which governs the eligibility of availing input tax credit, section 16.2, which lays down the basic principles. Over there, one of the principles is that to be eligible to avail input tax credit, you should have actually received the supply of underlying goods and services. Then there is an explanation that was added to it, which said that someone else receiving these services on your behalf will also be deemed that these services have been received by you as a consumer. So this explanation per se was added to meet the requirement of situations where an organization is making a consolidated procurement at central level, and that procurement is being consumed by all other states. So these examples get covered within section 16.2, and one should be able to defend the ITC in this case if department questions the ability. Only on the ground that the other states have consumed these input tax credit. I have got more question which says whether tax consultancy and Indian tax return filing services provided by CA are treated as export of services if provided to outside India. These will definitely qualify as export of services because these are pure consultancy services and professional advisory services, provided we are able to recover fees from our clients in convertible foreign exchange. Thank you, friends. With this, we will close the session, and it was great presenting these things to you.
Yeah. Hi, Chirag. Thank you, Chirayu. Thank you so much for such a wonderful presentation. And I was just listening, and it was such an extensive coverage. In such a limited time, you covered the circulars, references to the case laws, cross charge versus ISD, and you also covered circular 172, 178, which is not an easy task to cover in such a limited time. I'm sure the attendees must have gained a lot of knowledge to their knowledge pool today with this lovely presentation and the coverage you have taken. Thank you so much, Sir Amit Bothra and Chirayu, for the topic and lovely presentation today.
Thanks a lot.
I mean, I'll just close by giving one example, Shwetaji, Bhavnaji, that the last time we did the session on ITITS, after the session, a couple of members reached out, and if you recollect, we had extensively covered Gift City and the incentives around that. At least two of your members, to my knowledge, opened up an office in Gujarat, and one of them registered in Gift City. And today, I think the business in that region is doing better than their business in Bombay. So I think we take a lot of pride, in sharing information with you. This sector is definitely not. I mean, there are several clients who are not able to afford Krishnan sir or EY. So there is enough, for small time players and large players, to get into this market and definitely make an impact here.
Very true. Very true. So let's move further.
Yeah.
Bhavna? Yeah.
Yes, sure. So once again, good evening, everyone. And so before I take the pleasure of introducing our next speaker, I would like to express my gratitude to WIRC and Chairman Sir Arpit Kabra for bringing out such fine group of experts for enlightening us on such varied industries and GST or applicability on the same. And so now, before any further delays, I would like to, with all the deep pride and humility, I would like to introduce our next key speaker, Sir A.R. Krishnan, who is going to take the session on media, GST on media and entertainment. Anyway, sir doesn't need any introduction, but for the formality's sake, I would definitely go on. So, sir is a BCom honors. He's graduated. He's CWA. He is a 22nd rank holder in Inter CA, and he's also a law graduate and is practicing chartered accountant since 1981. His areas of expertise are service tax and GST, both in advisory and litigation. His major clients are large corporates. He has handled litigation at Sistat levels, and he has also briefed High Court and Supreme Court hearings. He has contributed to the study material, and when it was first to the IDT study material when it was first introduced in a CA final as a subject. He has conducted lectures on various forums and seminars. Also, he has contributed to various articles. He has conducted seminars for National Academy of Customs, Indirect Taxes, and Narcotics, Bhanduk, Mumbai, and also at various departmental forums. Sir has also made several pre-budget and post-budget representation to Ministry of Finance, Government of India on the topic of service tax. He has been a member of various committees as ICAI, WIRC, Bombay BCA, and Chamber of Tax Consultants. He has been featured as one of the top 10 indirect tax advisors in India on a survey conducted by International Tax Review, published from London in 2011. So, sir has a long list of achievements, and I think, go on for another half an hour for the same. However, due to time constraints, I would just hand over the session to sir. Welcome, sir.
Yeah, thank you. Can you hear me?
Yes,
Can
sir.
you?
Thank you.
Thank
so
you
much.
very much. Thanks, Vita. Thanks, Bhavna. Thanks for a kind introduction. Actually, you need to introduce only one thing. I am a member of the Institute of Chartered Accountants. That should be good enough. I think all said and done, I have learned a lot from this institution, especially the WRC. And it is, let me tell you, every speaking assignment to me is a learning experience, and I have gained more than what I have given, and I continue to gain. And straight away start. Now I have screen share. Can you give me a screen share so that I will put on my.
Do we need to handle it, or it will
No,
be?
no, we'll handle it. Only give us a screen share, right? So we will.
I think yes. Yeah. Yes, we can see the screen.
Yeah, the screen is clear.
Yes,
Yes,
sir.
sir.
See now, I have my format has slightly changed. I am not going to give any provisions because when you are given industry-wise, it is assumed that all the participants know GST law. And the way we have evolved, I don't think anybody is here who doesn't know the GST law. And those who don't know that would not come to this forum at all. Okay.
Because this is Relearn series.
Yeah, correct. So what I have done, I have only taken the issues, some issues facing, that way the issues can be n number, and it will be much more interesting. Like nowadays, in my days, when we were learning bookkeeping and accountancy, we used to look at Shukla Gravel and Bartley Boyd, understand the theory of accounting, and then start practicing the problems. But I am told nowadays it is the other way. The theory is taught by straight away starting with all the problems. And one by one, various problems, and automatically the person learns the theory. Now, which is right or wrong, I am not here to comment. So I thought if I take up some issues, which will be much more interesting. So my topic is media and entertainment. as all my presentations, it will start with that on content A. To those who are new, it signifies those days, you know, the movies is U, UA, and A. These subjects are really complicated. As regards the color blue, that is incidental, don't expect anything. Yeah. Let's look at the case studies in what are the case studies I have given. One is the ad agency business, the out-of-home media business, sponsorship by ad agency, film content processing, and music copyright business. Like that, if you look at case studies, there are many. There are two ways of dealing with any topic, the extensive coverage or the intensive coverage. I've gone for the intensive coverage, take a few issues and do that. And maybe while I take you through that, you will automatically know all the nuance of the subject. So let me go to the case study on ad agency. Okay. Case study 1, that is the ad agency business. So you have the caption. So this is a typical domestic scenario. If we all know, all these ad agencies, you know, advertising agencies from historically have been connecting the media with the advertiser. So let's take an example. Hindustan Lever is the wants to place an ad. They will go to a company like ad agency Lintas, who will decide whether it has to go to which medias, or they may allocate the funds with the print media, the broadcasting media, maybe Star or Z, and as well as the digital media and the out-of-home hoarding media. This is how the traditionally the ad agency work. So let's look at this three parties in this. You have the client, you have the agency, and you have the media. If you see the way the media is whether the print media or the broadcasting media, okay, they actually air the ads of the client. So they provide service to the client. But the payment and the agency gives services of actually giving the advice where to place the ad, how you have to do, perhaps even the creative. See, all agencies, you have got something called media buying and the creative. The creative is exactly the ad as such, how to create the ad. Media buying is syndicating between the client, the Hindustan Lever, and say print media or the Times of India or the Star. So agency is what it does that. It becomes an aggregator. The advantage is the levers find it easy to meet one, interact with one agency. The media also find that it is very difficult to go to all the clients. So historically, this is the job of agency. They have become like aggregators of a conduit in between both of them, for which they charge a commission. So if you see, agency gives his expertise to the client. Media is giving its this thing to the client, and the client pays the ad agency both the entire amount component of the agency service plus the media, and the agency in turn pays the media. This is how the whole thing works. Historically, it acts as the agent, but the contract may specify it could be principal to principal or principal to agent. So let's look at the some examples traditionally how it was. It was the say TV as well as the print media. So we can see they cannot see. So then it will be covered. Correct. So now, Bhavna, you can see me, no? Hello.
Yes, sir, we can see you. Yes,
Hi.
sir.
Yeah.
Yeah.
You can see, no? Fine. So, of course, if people see the screen, that's more than enough and they hear me. But I just thought
Yes, sir, we can see both screen and you completely.
Correct. Fine. So towards the media charges, the gross spend is 100 rupees, the print. There's a discount of 15% the media gives. The net is charged of 85. The service tax in the scenario of service tax was 12. Now, the bill raised by the agency on the client was the media cost plus the media service of 15%, 97.75, 85, and value of the agency commission 2.5% of rupees 100, because they don't charge the 15%. Because generally, the media buying is only 2.5% they get. The other 12.5% or lower amount goes to the creative agency. So the value for the agency commission 2.5% of rupees 100, that is sale of space 2.5. Service tax of the agency commission is 0.30. Now this is how the 100 rupees, they come across. Now the important thing which, total 100.63. What is noted is this 97.75 is a pass-through for the agency in the service tax scenario. Of course, there are a lot of litigation on the service tax. I don't want to take up into all that. That will go into a big tangent. But the fact remains that 97.75 is a pass-through. And the media will raise the bill on, say, Star, it will raise the bill on Hindustan agency with giving the reference of Lintas, who's the ad agency. Now, the value of agency 2.5 is the invoice of the agency, for which 0.28 is paid by the ad agency, 12.75 is paid by the broadcaster. This is how the whole scenario works. In the case of print media, there was no tax, I think, on those service tax at that time, and hence it goes like this. Now, this in case of this entire thing, now there is a big challenge. This is not possible because now there is a portal issue. So, if in the portal, it recognizes not more than one or two, only one person. So the dynamics have changed. And the TV media now cannot bill saying in the Hindustan get money from Lintas and bill them their 100 rupees, less than 15%, all that, it is all becoming very difficult. So what they decided, the industry as such, because important is, it was always historically understood that the agency is acting as an agent. Okay? But what is the principal supply is still the broadcasting. Now, what the industry, the client and the broadcaster all, as well as the media and all, together decided that the invoicing pattern would be like this. The TV media will charge the agency the entire 100 rupees. As on the 85 rupees, charging 18%, saying that this is a service provided to the agency. The agency will charge on the 100 rupees, 18%. This is the broadcasting part. The agency will claim when they pay 18% on 100, they will claim 18% 85 as credit, and that's why there is a seamless credit. This is a bit different from the service tax scenario. Now, why was this necessary? Because the invoice has to be issued with a GST number, and the portal recognizes only the person to whom the invoice is issued. So it was very difficult in the way it is done in the earlier scenario. And as far as the agency is concerned, they'll have to bill the client the entire amount. They cannot say 85 rupees is a pass-through and 50 rupees or 2.5 is mine. That's not possible. So they have changed this entire dynamics from principal to agent to principal to principal. So TV media is acting on a principal to principal basis with the ad agency, and the ad agency is acting on a principal to principal basis of the client. This is what the invoicing pattern indicates. Important is it should be also indicated by the documentation like the agreement, etc. Now, why is this all change I'm explaining is because at no point this ad agency should come out that it is purely acting as an agent. Because then this entire dynamics of the methodology, the billing may get into a problem. And this is also necessitated by the portal, by the ITC mechanism. And I think it would be very well accepted by the government. But they would see what was the previous GST thing. So you need to ensure all your documentation, invoices, work orders, agreements very clearly says that the TV media and ad agency have entered into principal to principal arrangement, and the ad agency has entered into client to principal. Then this whole thing works. Now you have the print media where it is 5%, 5%. Now the only issue in the case of the print media, there is an issue whether, and there is a press release dated 23rd August 2017 where you can have a look, where they try to explain the nature of the transaction. If the ad agency has acted as a principal to principal, then this mechanism works. That the print media charges 85% and 5% is levied on that. Ad agency charges 5% on 100 rupees because the nature of the contract, nature of the service doesn't change. It is still print media services. And then it takes credit when it pays tax on 100 against on the 5% or 85 levied by the print. The press release is very important. It wants to say that if he has acted purely as an agent, then this will not work. Then the ad agency for its commission part will have to charge on the entire 18% on the 15 rupees, and on the 85 rupees, the print media will have to charge the client. That is how of course, not coming out so directly, but it says that if it's a principal to principal is okay, but if he's acting as an agent, then this will not work. So please go through the press release where it's got a background, especially looking at the pre-GST scenario. Client's perspective, what is he doing? We need to look at what the client is getting. It's a display of advertising on a television print media. It is the predominant objective. The objective is that. So we have to say the principal supply is the media services. Because here, the department say agency when is levying, there are two services. One is the print media services and the other the agency service. But we'll have to articulate saying that principal supply is the print media. And there is a P2P between print media to ad agency, P2P between ad agency to client, and it will be 5% throughout. There should be no issue of 18%, no issue of breaking the supply into two supply, print media and the ad agency. This is the important thing which we need to take into account. This proposition may be applicable in other industries too. Then we have the cross-border scenario, which may, I understand in some quarters it has come through. We need to look at what the cross-border scenario. Cross-border scenario, there is a client abroad. He approaches a foreign agency to place an ad with the Indian media. And for that, he takes the help of the Indian agency. And the Indian agency approaches the media. This is how the whole transaction. So the services are actually the media is placing the ad for the client. And but the entire thing is routed through the Indian agency and then thereafter to the foreign agency. The issue would arise, and I'm told it in certain quarters it is arising, whether the Indian agency has acted as an intermediary. We have enough issues on this intermediary. I'm not taking into account the recent Bombay High Court judgment at all. That's, let's keep that aside. But the matter remains that if the Indian agency has provided advertising services, then it would be exports, there should be no issue. But the Indian agency has acted as an intermediary, then an issue may arise whether the part of the Indian agency's commission would be considered intermediate tax would be applicable, and on the media part of it, there would not be any tax. So this is a very important thing, how you will go about. Of course, all this would depend on the nature of the contract and the documentation. Yeah. If the contract is properly stated and where the intention is that between the media and the Indian agency is a principal to principal, between Indian agency to foreign agency is principal to principal, and between the foreign agency to client's principal, then there should be no issue. We need to also understand the conduct of the parties. there are many factors which will give you some indication how is the conduct of the parties. Everything is rooted through the what should I say, through the Indian agency. Who is responsible for the payment? Who is responsible to ensure that the media is placed properly? All that would give an indication that it is a P2P or P2A. We need to also understand the accountability. Who is accountable to whom? So if you say that it's a principal to principal at all places, then it will be considered advertising service. However, if it is P2A, then you may have to split it. And the intermediary part, the commission part, may be liable as the intermediary services, and the media part may not be liable. But here again, one may have to also understand that if we can articulate that the principal supply is still the media services, that is the principal supply, and intermediate supply, if any incidental, we may still be able to articulate that it is an export, it doesn't come intermediate. But I would say, I would caution that as far as possible, you have to ensure, because we cannot say composite supply is a separate subject, because the GST laws compartmentalizes into composite supply and mixed supply. But there, in my view, there's always a third supply, where there are two supplies, two independent supplies. Because principal supply is there only if the other supply is ancillary or incidental. But if there are two independent supplies, then neither composite supply law nor the mixed supply will come into play. So this is where this entire transaction has to be carefully documented so as to ensure that it is very clear that for the media, Indian agency has got a principal to principal, and for the foreign agency, it has got the principal to principal. This is a very important thing. Yeah. Here, the media, it should not look like the media is giving service to him or to him. This is a very important thing. Of course, one can say for the media, the recipient is the Indian agency, because he is the, what should I say, the who is obliged to make payment. Of course, the media may charge full tax on the Indian agency, but he can take credit because he will be treating these as exports. I am used to, physically
Yes, sir.
talking and, the physical seminar where people, I can find out their reaction, whether they have any questions on this. See, they may have separate questions which they have come for, but on this as such, if they have any question, should I take it now so that it is fresh, or should I take it later? That is where I want to ask you.
Sir, as you are comfortable, if you're comfortable taking now, that is also okay. Because,
I can take now because people's retention is there. If you can read out what is the question, if it's concerning these two, if it's concerning a different one, we'll take it in there. Is it concerning these two presentations? The two.
Sir, right now people have not posted questions related to this presentation.
Okay, then no problem.
Yes, sir.
Yeah.
Yes,
When they raise a question on the PPT which I have given you, then please immediately do so that I can address the question immediately. Yeah.
Sure, sir. Sure.
Yeah.
Yes.
And participants are also free to raise the question. I don't mind being interrupted. I know it's very difficult. By the time I have finished the 5th case study, nobody may remember the 1st case study. And then to ask questions after everything is over, you'll also be tired. So you can at any time interpose at this stage itself, and I can certainly.
So there is one question which we have got. If you would,
Yeah, tell me.
okay,
You only read out, no? If you don't mind.
Yes, sir. Sure, sure.
Yeah.
So the question is whether corporate entity act as a provider of ambassador services by hiring celebrity on P2P basis. If not, whether such arrangements would be termed as intermediary service provider only, documentation to be executed either by party agreement or tri-party agreement.
Oh, come again. What is the?
Sir, I would read the first part of the question.
Yeah,
Whether
please.
corporate entity act as a service provider of
Yeah.
ambassador services
Yeah.
by hiring celebrity on P2P basis.
Yeah. Yeah.
If not, whether such arrangements would be termed as intermediary service provider only.
Yeah. So if the see, I think that is where I said you must word the contract in such a manner that it becomes P2P, because to the client is the corporate entity who is responsible, and to the celebrity is actually looking at the corporate entity who is doing that. So I would say it all depends on the contract. If you want to make things smooth, nowadays everybody is going for P2P and not P2A.
So the last part of the question was documentation to be executed either by party agreement or tri-party agreement.
I think you can do it bilateral. That is much easier. No, A qua B and B qua C. That may be much better than tripartite. When if it's going to be P2P, there is no need of a tripartite. Yeah. Now, of course, there is an issue. I know about one important issue, that the client would like to enforce the documentation against the celebrity. So maybe to give that comfort, you can have a tripartite, but if you want to build P2P, then you better write that all the things are based on P2P and not P2A. Yeah. But if you ask me, if everybody is comfortable, two separate bilateral arrangement is much better. I know practically it's difficult. Yeah.
So I hope the query, the answer is clear to the attendee.
Yeah.
So there is no further question as of
Fine.
now.
So let me take it to the next one.
Sure.
Case study 2, out of OOH media. This is, the hoardings. We see a lot of hoardings everywhere. That is one part of an important part of the thing. We know there are certain ads which cannot be shown on the print media, which cannot be shown on the broadcasting media. I think if my memory is right, the ads for cigarettes as well as alcohol and all, it cannot be shown. Especially cigarette ads, and you see more in the hoardings. So in any case, it's an important media, though with all the, at least in Bombay, with so much metros coming in, we don't know to what extent the hoarding signs are visible. But it's an important. That is why it says out of home media business. Let's look at what is the issue here. The issue is the hoarding is in Karnataka, the physical hoarding. Now, what is the hoarding? Hoarding is actually either in a highway where there is a tender bid with NHAI, but nowadays highways also, as far as possible, they avoid hoardings because it distracts. Or on the road, there could be municipal tender, that is one thing. Or there could be a building where the society or the landlord tenders. And then you take permission to put the hoardings. And once the hoarding is put as erected, then you say that to go to the marketplace to say that you can display your ad. Nowadays, the flex printing, you can display your ad for a particular period and they charge per month, maybe 5 lakhs, 10 lakhs per month or 3 lakhs per month. This is the hoarding contractor charges. Now, he may go directly to the advertiser or he may do it through the agency. But important is any hoarding has a fixed structure. And on the top of it, the whole thing, if you have seen the hoardings. And that is how the whole issue has come up. The hoarding owner, that is the media owner, he is, charging to the agency in Maharashtra. The owner is saying in Karnataka, he charges to Maharashtra. Maharashtra charges to the Gujarat. This is how. The issue is whether you have to charge CT plus ST or IT. Now, why is this issue coming? Because advertising basically is recipient based. So normally the hoarding owner would have charged agency, say maybe about 85 rupees. IT, and the agency would charge the Gujarat advertiser IT at 100 rupees. And he would have claimed credit. It would have been seamless for everybody. But the problem arises that there is a view, some of the, perhaps for the department, they feel that this holding owner who's charging to the agency, the place of supply is not the recipient base. Section 12. Yeah. They say it is not section 12.2. They say it is section 12.3, which is the immovable property criteria. That structure is actually a immovable property. Yeah. And hence, since you have this rented out for 3 months or 2 months, immovable property, the place of supply is Karnataka. So service provider is in Karnataka. Place of supply is in Karnataka. And hence, it is intrastate supply. And you have to charge CT plus ST. Now, if we charge CT plus ST to a person in Maharashtra, for the Maharashtra fellow, he can't claim credit of CT plus ST of Karnataka because the portal doesn't allow it. This is the issue. See, portal has become the king. Whether it is right or wrong, we are not questioning. That's another subject. Whether such a thing, rights, somebody can bind. Because the whole idea of GST was seamless credit. That was one of the whole thing. But this is a big challenge here. And then again, when the agency charge in Maharashtra, whether the place of supply is become Gujarat because recipient base, but whether he will say the place of supply is in Karnataka because it is immovable property. Of course, at that point, he will still levy IGST. That should not be a problem. But the first stage, that is the problem. So here, I think we have to understand that what the hoarding owner is giving, media owner is giving. He is not giving property, immovable property on rent. It's totally a different service. He is giving a bouquet of advertising service. Yeah. The whole thing is made the infrastructure in such a manner that what he is doing is he is displaying the ad of the advertiser through the agency. So really speaking, is an advertising service. And then, he is giving what should I say? It is not, he's giving a space. It is not a supply of, he's not allowing anybody to enjoy the property as such. Okay. So here, of course, we'll have to argue with very nicely that what the landowner is giving to the media owner, that is, one can say, he is a immovable property criteria because there's a landowner. So he is giving that. But this person has organized something in such a manner that is allowing somebody to display, because this agency or advertiser does not have a complete right on that entire property. They are not able to use the property at their whims and fancies. They are only allowed to display the ad. And many times it is the media owner, the hoarding contractor who displays the ad, for which he charges extra for the flex printing. So actually, it will not come under immovable property criteria. In my view, it should come under the residuary category, location service recipient criteria. And hence CT plus ST, which some of the department is saying would be liable, is not correct. Accordingly, it should be IGST. And if it is IGST, I think there should be no issue. And that will be a seamless credit. Now here, we need to understand that this has to be, again, a lot will depend on the work order and the contract. If the work order, the contract is very clear that it is display charges. And historically, if you see the earlier bills also, the media owner always says display charges. He doesn't say license fee for use of my this thing, or he does not say for normal rental contract. That manner it is never done. And there is no license agreement at all, which is registered with the registrar, sub-registrar. It is only an invoice with a work order for display charge. If that is so, to my mind, there should be no issue. Please understand, I am taking all live issues, which are really, it's not out of my imagination. Yeah. So it is all cases where things are really happening. Bhavna, can we go to the next one? Hello? Let's look at the next. Case study 3, sponsorship by ad agency. Now here, this is one important thing which is affecting the ITC chain in many respects. Now, how is it affecting? Because, see, there is an agency, there is an advertiser who says that there is an IPL event or any football match event. Okay. In that event, I want to place my ad. Okay. I want to sponsor, not place, I want to sponsor that event. The whole event is sponsored. And in that sponsor or a fashion show. And that event, there are gold sponsors, there are silver sponsors, there are platinum sponsors, all these people. Now, when the event money person who is receiving the money, he charges the agency. He says it is on the reverse charge because sponsorship is on the reverse charge. I have never understood why unnecessarily this created this problem. And when the agency bills again the advertiser, it's the reverse charge. Now, what is happening for the agency? That outward supply is exempt since there is no tax under the reverse charge. Any supply on which reverse charge is paid by the other person, service recipient, then for the provider it is an exempt supply. And if it is an exempt supply, what happens is, whatever input credit you cannot claim, this is a very major issue. And hence this ITC chain is broken. Issue is there any way out? What can we do? This is a very important thing where people are just struggling to find out what should we do. So here I think a couple of things we can understand. I've seen one thing is whether the agency can say, but in this case, we will do P2A. And agency will bill only for its commission to the advertiser. Yeah. And charge the GST. And the event receiving sponsor directly bills the advertiser. And the advertiser pays on the reverse charge. And thereby this entire ITC mechanism is kept intact. This is one thing, this is where there's something called the direct billing. But this may not be always possible. In which case you run this risk. The other thing which I have noticed, in actual fact, many times this is not sponsorship at all. If you look at a detail, what should I say, what the advertiser is getting is not in vacuum, just like gold sponsor or this sponsor. He is getting the right to display his ads at various locations. So actually, in effect, it is like the earlier hoarding contract. It is display charges. It is simple ad display charges. If it is ad display charges, then it is a location recipient criteria. It is not sponsorship at all. It is a forward charge. So the event receiving sponsorship company can charge agency and a forward charge. Agency does a forward charge advertiser and there is no issue at all. But this again, you need to look at the work order and the contract. I've seen most of the places, the rights of the sponsor, the person sponsoring, is just to display the ad. Then might as well, why have a different form against the substance? In substance, it is to place an ad, let it be that the ad is placed. And then accordingly bill. I'm next on the case study, film content processing. This is a very important case. Yeah. And where we are seeing there are various content processing companies in India who are in the business of film content processing. So basically, they work for, say, a step-down subsidiary abroad who have a contract with Hollywood production houses, or they have a direct contract with the overseas Hollywood production houses. So what do they do in that? The film content, that too very small part of the content, which they call frames, they come to India. It is sent through the internet, online, and the content processing house here in India, that is the service provider, either does say some special effects or converts from 2D to 3D. These are the things which he does. What is the reason? Because in India you have a very good technology, manpower, you have very good facility, and also is very cost effective. So that is the reason it's actually a media house out processing mechanism, and this is in a big way. And special effects has become very important. In fact, many of the films nowadays is more on special effects than in the actual acting. Yeah. So, and many times it's also required to fill in a gap. If some shots are forgotten, those shots can be through special effects covered up, or some mistakes can be covered up. So these are the things which this film processing unit does it in India. And it does for the person abroad. The issue here is, which is very important, that when the content comes in India, this person in India, he raises an invoice treating it as exports, zero rate. And here, both in service tax as well as GST, the issue has come up whether such a case is exports or not. Now, why is this come up? Because the department says the place of supply for this content is where the performance is. Because the performance is in India, and hence if the place of supply is in India, there is no exports. Unless the place of supply is abroad, there is a residuary criteria at section 13.2, correct? Between 2 and 3. Yeah, these are 13.2 and 3. So they say it's 13.3. They say the online content which comes is goods. Hence it is work upon goods, and POS is in India, and hence it is not exports. This is what the contention of the department. Let us look it up. 13.2 or 13.3. For section 13.3, that is where the department is invoking to apply, it is a work in respect of goods. So 4 conditions are necessary. Goods must be given by the service recipient, that is the overseas production house. What they give, it should be goods. Goods are required to be physically made available to the supplier. This is what the section says. It's not only goods should come, they have to be physically made available to the supplier. The service must be in respect of goods. That is, it should be on those goods, on the online content. And further, there is a proviso. If those goods are imported temporarily for repairs or other treatment or process, and exported after such repairs, treatment, or process, without being put to use in India, then this particular 13.3A will not be applicable, which means automatically it will come into 13.2, which is the recipient criteria, and the exports will be given. This is a very important proviso. So we have to check up whether what is the issue which is to be framed in this case study. What are the issues to be framed? Whether what the online content is goods, whether assuming that they are goods, whether they are physically come. Now this, whether service is in, that service is on those goods which has come, and whether that proviso, is it a simple case, it comes, you do some process and goes back abroad, then it will not be applicable to be treated as exports. Now here I think we need to understand one by one that this online content, would it be considered as goods? Now, for this argument of goods, one would say, what is goods? If you look at the TCS judgment, I'm giving you the citation, 178 ELT 22 Supreme Court. This is TCS versus State of Andhra Pradesh. It is affirmed in BSNL versus Union of India 2006 2 STR 161. It defines what is goods. I'm again giving the citation. TCS versus State of Andhra Pradesh 2004 178 ELT 22 Supreme Court. Affirmed in BSNL versus Union of India 2006 2 STR 161 Supreme Court. Now, what does it say? First of all, the goods which comes in order to be considered as goods must have utility. It should be capable of being bought and sold in the marketplace. And it should be capable of being transmitted, transferred, delivered, and possessed. So here, the first two criteria, these goods may not fall. Because what the content comes, many times the content comes, not the whole film comes. Some small, insignificant part of the film comes. In fact, most. And that too, only the video comes, the audio doesn't come. And it is called a frame. So really speaking, it has got no utility to anybody. So it doesn't have the character of goods as it is understood. Second thing, it cannot be bought and sold in the marketplace. If suppose somebody gives us the right to even buy it and sell it, but that is not an item. That is only given to us so that we can process it and give it back. So it cannot be bought and sold. So, and this criteria which is given by the Supreme Court, it should meet with all the criteria. I am not here whether it cannot be transmitted, transferred and all that. That part of it we leave. But two important criteria it doesn't meet. One is it should have the utility. It is of no use to anybody. And it cannot be bought and sold. So on this point itself, it will not be considered as goods. Then if you look at, see when the negative list came in 2012, the board issued something called the education guide, which was the landmark, I think Mr. Garg, who was the architect of that, one of the best pieces of literature given by the government. Though they say it has only persuasive value, but it has been relied on in many judgments too. So this education guide is very important and it has dealt with this, our situation. So and because these are images and contents. Okay. Now what it says, if you see para 6.4.4 in the education guide, delivery of content online would also not amount to transaction goods as the content has not been put in the media before sale. There is a whole judgment of ACEC 128 ELT also, which says in order to be considered goods, the content should be put in the media. This is the context of customs. So, delivery of content would not amount to a transaction goods as the content has not been put in the media before sale. Delivery of content online for considered therefore amount to provision of service. If somebody gives the content, that is the provision of service. That person giving service. But there is no goods. So this, their own education guide says. Incidentally, this is one also, this is a case which I argued before the tribunal successfully. And hence, I am very much conversant. These are all the arguments which we have put. The case law is CST versus Prime Focus Limited. TS 27 Sestat 2023 ST. CST was a Prime Focus Limited. TS 27 Sestat 2023 ST. Next important thing is the education guide also says that, and this is very important, services that are, and it is in this context because this section 13.3 was there in Rule 4 under place of provision, where they say services that are related to goods and which require such goods to be made available to the service provider or the person acting on behalf of the service provider can be rendered or covered there. The essential characteristic of service to be covered under this rule is that the goods temporarily come with the physical possession or control of the service provider, and without this happening, a service cannot be rendered. Thus, the service involves movable objects or things that can be touched, felt, or possessed. Examples they said was repair, reconditioning, or any other goods, storage and warehousing, courier service, cargo handling, technical testing, inspection, certification. So it's very important that it should be physically coming, where you can feel it. Or online content, you can't feel it, you can't touch it. And what is the purpose of this rule? The purpose of this rule is those which actually come for repair or storage and warehousing services in India, cargo handling services in India, where actually you are dealing with the goods, you are working upon the goods. There they will consider that it is a place of performance. If a person abroad, for him you store his cargo here or handle his cargo here, this will straight away come under this work upon goods. The place of provision would be India based on it. But it is not to cover such cases where the online content is coming, where it's not physical, you can't feel it, you can't touch it, it's not tangible. This issue has also been dealt with in one more place in para 5.4.2, especially in the context of this goods imported temporarily. In the field of information technology, it is not uncommon to provide service in relation to tangible goods located directly from a remote. There is also a remote case where somewhere else the server is abroad. Thus, the actual place of performance service could be quite different from the actual location of a tangible goods. This proviso requires that the place of provision shall be the actual location of goods and not the place of performance, which in normal situations is. So, everywhere the concept is that it should be tangible goods. Then only this thing will be triggered. And this tangible goods is there in the prime focus judgment also, where the member, as the judge has said, that it should be tangible. And in order to understand what is this physically means in bodily terms so as to shape, size, other material. And if you look at this, one more judgment in this context of physically said, IDEX India Private Limited versus CST, T727 Sestat 2023 ST. IDEX India Private Limited versus CST, TS27 Sestat 2023 ST, where they have said data sent for processing through electronic means in an incorporeal form and not physically made available. So this, they say, such a data is not physically made available, hence it is not physically sent. So you can rely on this judgment too. A, you can say it is not goods, it is not physically coming, it is not tangible goods, you have that prime focus. You also have education guide, and then you can also say this is not physical based on this IDEX India Private Limited. So all this would be enough to tell you that this will not be goods. Of course, you can also say, assuming it is goods, these are all alternate arguments. First is not goods, assuming it is goods, it is not tangible goods, assuming it is so, then it is not physically made available, and still worse, you fail all this, you can say you are governed by the proviso, you treat it as goods, I have worked upon the goods and sent it back in the same form without putting it into use in India. It straight away attracts proviso, and it attracts proviso, it will not attract this section 13.3, which case it will not be under the performance criteria, it will be recipient criteria, and hence it will be considered as exported. This is all the arguments one can take. There's one more judgment you can think of, Adventist Therapeutics, 51 STR 298, which says that such a case will be applicable only if there's a, will not be applicable if the goods, they get altered in a new commodity. Actually, in this case, what comes in one raw form, when it goes back is in a different form. So one can take recourse to this judgment also, Adventist Therapeutics, 51 STR 298. There are some other arguments also. In this regard, you can look at circular number 209/1/2018 ST dated 4/5/2018. I'm saying once again, circular number 209/1/2018 ST dated 4 May 2018, where they have said the software development enhancement, etc. on data instructions provided by the client, the place of provision locations. So we have very clearly said all this data processing, software development, you can, of course, this is not directly on the point, but you can try to articulate it and use it and telescope it to this issue and say that in this case also there is a data processing involved. And hence say that based on this circular 2, one would say the place of provision, place of supply is recipient based and not the provider based, where it is considered work upon goods. Then you can also look at one more judgment. It is Sure Prep India Private Limited, CGST 2019, 24 GSTL 252, Tribunal Mumbai, where it says service of data processing falls under Rule 3 of POP rules in parameter with 13.2 now, and not under Rule 4, which is in parameter 13.3. So this Sure Prep also is very important. You can use that. Sure Prep India Private Limited, 2019, 24 GSTL 250. So this is a case where we can say that it is not coming under the work upon goods criteria, but location recipient. So I think there are enough arguments, but I understand the department is still taking it up. Perhaps they feel that they are still not, they feel they still have a case. Okay. So we'll have to see how it goes. But if you get such a situation, you can see this Rule 3, Rule 4, there will always be a temptation. That is 13.2 and 13.3. There is a temptation. 13.3 is work upon goods. Yeah. Not even government. So this is always a temptation to say that it will be work upon goods. We'll have to articulate. Yeah, Bhavana, you're still there?
Yes, sir.
Yes, sir.
Yes,
Is
sir.
there any question so far on whatever I have dealt with before I go to the last one, which is a bit lengthy?
So there was one question in between. Can we litigate if we are unable to get the credit?
Regarding,
But I'm not. Yes, sir. I am. The
you don't
question is
have,
incomplete.
yeah, but
The,
what context, which case study?
sir, I think it was the third case study.
Third means which one that
If I would request Mr. Prasad, if you could type the. It was the third case study, sir.
okay, study, which is the third case study. Is that the sponsorship one?
Yes, sir.
Acha, you don't have any mechanism to make him speak, no?
No, sir. He can type. He is typing.
He's typing. Okay, so let him type. Then you tell me.
Yes. So, sir, he has mentioned that it was the third case study. Sir, can you type the name of the case study, please, Prasad, Mr. Prasad?
Okay. Is this the one?
Yes, sir. Yes.
No, but he says we can litigate, but then litigation, that means you want to say that the supply on which RCM is paid should not be treated as exempt. Perhaps that is what he wants to say. But I don't know whether this will.
So he has written the sponsorship issue if not getting the credit of the hoarding by intermediary person who is the other, who in the other state will get. I think this is what he wants to say.
Right. Let me
I
see
think
which one. What is his name? Prasad.
yes.
Okay, we are also opening. So the sponsorship, if not getting the credit of the hoarding by the intermediate. No, there's no hoarding in the sponsorship. So he's confusing. There are hoarding is not there. Here it is an event. See, we are not able to understand. He's mixing up two case studies. One is the earlier case study, which is on hoarding. This is on sponsorship. So both are getting mixed. Yeah.
Okay.
You are not able to open him to speak.
No, sir.
Okay. ask him to type his mobile number. No, I'll call him. Okay. Tell him to type
Yes, sir.
his mobile number. I'll call him. Okay.
He is hiding because you have stated that the GST authorities are not giving IGST, as they say that there should not be CGST and SGST. There should be CGST and SGST.
So that I told you, no, there's a good place to say that. That is not case study 3, it is case study 2.
Yes, sir. So he must be confused now. So he's referring to case study 2.
Yeah, I think he's concerned with this.
Yes, yes, sir.
He's concerned with this. This is not an issue because you'll have to say it's a display charges. And if he says should we litigate, I said yes, certainly we should do. Okay.
Yes.
Prasad is from where? He's freelance or is he given his coordinates?
I think, sir, his query is answered. He has written thank you.
Oh, very good. Thank you very much.
Yes, sir.
I gave him his Prasad.
He is from Mumbai, he said. Yes, sir.
Fine. Thank you.
Yeah.
Also, before I go to the last case study, I'll just have a look at all the. Just look at it. Right. We'll go to the last case study, which is a bit lengthy, but I think interesting. Let's see. So this is a music copyrights business. Okay. Now, what is this case? Let's understand. This FCO, that is FCO is a foreign company abroad. It owns a website and mobile app for streaming music. It enters into a, see, if you see this is the red dividing line. Above is outside India, that is assuming Netherlands. This is India. Okay, this is a very important thing. And I have also prepared this entire white block. And I'll give you the example. What is the white block is the footfalls where these mobile app streaming is. So there is a, shall I say, the Indian subscriber who subscribes to the FCO company, who owns a website mobile app for streaming music, where the music is streamed only to India, because the copyrights are, there is a lot of species of copyrights. This copyright, we are only concerned with the India-based copyrights. So A Limited owns a copyright music. So the India part, F company, who wants to get the right to stream, whenever a person goes to their app, he can see whatever music which is there of A Limited, and he can download it or play it, and for which he subscribes and pays. Now, of course, why is it a F company? It is owning a website and mobile app for streaming. Why does it want? Because it is collecting a bouquet of all the music. Okay, and also it gets subscription revenue, plus it may also get ad revenue. This is all the why F company is in that business. A Limited company has got copyright in some of the music. Now, there is a I company Indian counterpart also of the F company. Okay, because this F company has to have I company as the Indian counterpart for two reasons. It has to interact with the A Limited for the copyright owner for ensuring that everything is properly done, and it also collects the subscription revenue for the Indian. So if you look at this A Limited gives license to this foreign company. And the F company actually, they pay this A Limited money in foreign currency. Sorry. And this A Limited is treating these as exports. Now, obviously, there is a music which is uploaded, which sometimes is routed through the I company. So I company will upload this music, or it may give the uploaded music to them, whichever way. We are not very much concerned about that. But there is an interaction both at the contract stage and at the regular stage, the I company. This Indian counterpart is maybe a subsidiary of F company, in some way related to F company. So here we have to see how the services are going from here. The license is going there. Yeah. But sometimes the uploading may be done through I company. Okay, for whatever administrative purpose. Money is received here. Now the issue is whether the services of A Limited is provided to the F company or whether it is provided to I company. Who is a service recipient? If I company is a service recipient because it's interacting with them, then the service recipient in India, you lose the exports. If F company is a service recipient, there is no issue at all. This is the issue under consideration. See, this issue whether which establishment is nearer to the concept of service recipient is an issue world over. It's there in UK VAT, EU VAT, cases have come across. Especially, I have not taken one important thing, global framework agreement. In global framework agreement also, who's providing service to whom always comes into play. I've taken a more simplistic example. Now, what is the important thing? The footfall of the license in India. So it is actually for the Indian listeners. This is a very important thing, which will, trigger sometimes a person in the department persuaded to say everything is happening in India, you cannot have exports. But that's not true. All interaction is the I company, that is the Indian fellow, who is also situated in India. Both at the agreement stage plus the work mechanism, because there is also a log management. How many times this money is paid upfront once lump sum, because how many times that is used. So that management may be done by the I company. Whether the supply made by A Limited is zero rated or liable to GST. Now, why they are asking? Well, if you say the F company abroad is the recipient, there is no issue. If we say the Indian company is the recipient, there is certainly an issue. GST, SDC to be levied on all interstate supply of goods and services at rate notified. IGST is to be levied on all interstate supply of goods and services at rate notified. Tax to be paid by taxable person. Nothing new about this. In a cross-border interstate supply, there is an import of goods, import of service, supplier in India and POs outside India. It is export of goods. We are concerned with this last one. Okay. Now, what does the exporter service say? Exporter services means the supplier of any service when the supplier of service located in India, the recipient of service is located outside India. So here the recipient of the service is located outside India. Of course, whether F company is recipient or I company is recipient will come to. Then the place of supply of service is outside India. So, no, here we are saying the place of supply is where the recipient is situated and he is abroad, so there is export. The payment has been received by the supplier and service is converted for exchange. E is not relevant. Now, supplier of service located in India? Yes. Recipient of service located outside India? Yes. No. Sorry, question mark. This is where we are going to determine whether recipient of service located outside India. Place of supply is outside India, we are going to determine. Payment, yes, there is no issue. So 2 and 3 are the issue. And in effect, it all boils around only one thing. Who is the service recipient? Now, here, there are 3 important factors. One is the supplier, location supplier. That is A Limited in India. Then location of the recipient and the place of supply. Now, place of supply for such services is the recipient. So the question is, we have to ultimately, if we have determined who the recipient service, then we have determined the place of supply also. And if it is recipient based, if the place of supply is recipient abroad, no issue. Now, who is the recipient supply? If you would say is F company, then location of recipient outside India, POs outside India is 0. If you say I company, LOR is a location of recipient in India, POs place of supply in India, there could be a liability. Why is it that this I company would be considered a recipient only? Because there is a lot of interaction with them. They have to be the entire access to the music and all is given to them and is routed to them. And they also have presence in India. The subscription is collected in India for the Indian public. And the footfall is in India. These are all the reasons which trigger somebody to take this view. Now let's look at the location of service received. Now here we say clause supply received. If the supply is received at a registered place of business, then that is the place of the business. If the supply is received at a fixed establishment, other than registered establishment, location of fixed establishment. This is all the definition of location of service received. If supply is received more than, this is where the whole issue is. If it is received in more than one place, then you need to only articulate who is directly concerned in receiving supply. Is the person abroad is concerned with receiving supply, or is the person in India concerned with the recipient of supply? Whom would you consider is a more important person? Of course, the person may say the contract is with the person abroad, but it is the PI company who is receiving the supply. I company then thereafter gives it to the foreign company to upload it. It is uploaded from abroad or maybe even uploaded from here. And the footfall is in India. It's for the Indian person. So we would consider I company. The other view would be no. The person is by contractual obligation with the person abroad. He is the person who is supposed to give me the service. Because these issues have come up abroad too on all these matters. So here one must look at what is the definition of receipt and supply of goods or service. Look at section 2 into 93 of CGST Act. So what does it say? If consideration payable for supply, person liable to pay the consideration. We are more concerned. So the recipient of the supply is the person liable for consideration. Now obviously the recipient is the person abroad. And the person abroad is the recipient, he is liable to pay consideration. So we can say he is the recipient of service. We get straight away. But here they may also say, look at also the definition location of recipient service. He may be the recipient, but we will consider both recipient and who is more concerned with the supply. Now, I would say that whatever I company is doing is only to facilitate the whole transaction between the A company in India and the company abroad. And really speaking, it is the person F company abroad who is receiving the service, who is getting a rights on the copyrights, and who is actually conducting the business of the entire, what shall I say, streaming, etc., etc., etc. I company is doing a facilitating mechanism, and for which I company is already charging separately to the F company. So I would say there is a good case to say, in fact, F company, we can say, F company has established in the Netherlands and A Limited is contracted with F company. COA is established in the Netherlands and is obliged to render his licensing service to work. Because there is a license entered into. I think it is under section 30 of the Copyrights Act. So that license is entered into with the F company abroad. So really speaking, F company is the person who is having the rights. So he is the customer and he is the recipient service. The benefit of A Limited services accrue mainly to F company located outside India. Only F company is legally obliged to make payment or consideration of supplier by A Limited. I company is only a communication conduit between A Limited F company, not a beneficiary of A Limited service for the agreement. That is very important. Hence, it's a good case to say that the location is outside India and PO is outside India. Supply of A Limited would be zero rate. Now, the only thing which could be, we have articulated I company can be completely neutralized with this argument. F company is abroad. The only thing somebody may say, the footfall of the music is in India. But that is okay. The issue is, tomorrow I may give services to a person abroad. Say, I am a consultant, a chartered accountant. Give the consultancy abroad to Microsoft. Say, recently Apple. It gives like a consultancy, a feasibility study, whether if you put stores, where are the places you have to put stores in India, which are the best location, and what would be the likely profitability and what should I say, the turnover, and which would you say the 10 best location. If you give such a study to Apple abroad, it may be utilized for the Indian business, for the Indian location, but it would still be for the benefit of a person abroad. That is very important. And he gets the benefit. Hence, he is a service recipient. And hence, one would say the location recipient is abroad. And hence, it will be considered place of supplies abroad and it will be considered exports. So, this way, the footfall argument also can be neutralized. I think I come to my end of the presentation. If you see my thing, like all presentation, left side is a lighthouse, right side is a confused person. Whether I have thrown some light or whether I confused you, you only are the best judge. Now, should we see the questions?
So there are no further questions as I could see.
Oh, very good, very good. Excellent. So, shall we close this or anybody would like to ask any other questions?
So we'll just wait for a minute if anyone is.
Sure. I think everybody must be tired also. They would want to go home. Also, they are working from home only, but.
Might be, sir.
Is there anything?
No, 1 minute, sir.
We'll give some time. Give some time. If somebody's typing.
So someone has typed one question. If credit note is not uploaded by the supplier in GSTR1, when should recipient reverse the ITC? At the time of note uploaded by the supplier or when the goods are removed from the premises?
You don't have a topic on this? I thought this is my focus is only on
Media
and entertainment. If credit note is not uploaded by a supplier, when should recipient reverse the credit? At the time of the note uploaded by a supplier or when goods removed from? No. What does it say? You understood what it's saying? Like I said. Only when credit note is issued. Oh. Yeah. Because okay. How you can reverse? So what it appears that we have to reverse.
Same, yeah, we have to.
And somebody returns us the goods. If credit note is not uploaded by the supplier, my vendor, when should recipient reverse the credit? At the time of note uploaded by the supplier. No, if the supplier doesn't upload, have a credit note, you can still continue with the. I think it should be at the time when he uploads the credit note. Yeah. Anything else?
So someone has written, can you share some more insights on levy of GST on copyright services?
Can you share some insights on levy on GST on? No, that's why I think yes, the last thing was on copyright service. No, that copyright service, there are so many services. If he can just tell me what anything specific he wants, then we can do. And anyway, Nitin Bhuta, I think I know him. He can contact me otherwise also. Right. Anything else?
No, sir, then I don't see any further questions.
Yeah.
Yes, sir. So then we would just conclude the session.
Yes,
And
unless
yes,
there's somebody else is typing. No.
I don't think so.
I think we-
No, sir. Thanks. No, no, sir.
Yeah,
I-
so there is only a thank you for a wonderful brainstorming session. It is getting more and more interesting as the case studies are. Where is it? It's progressing. So, okay, fine, fine. That is Prasad. What is the other one? Credit note. The credit note is over. Nitin has said thanks. That's
Yeah.
an anonymous attendee. Part 1 CP credit not uploaded. So that is for you, huh, Bhavna?
Yes, sir. Yes, sir. I'll
And,
attend.
and while you are there, see that Mike CP also is uploaded.
Sure, sir. I.
Okay.
So we cannot miss on your CP.
I don't know. Well, still today I have never seen whether my CP is as a faculty I get it or not. I have no idea.
नहीं sir, इतना
Fine,
तो
no?
yes sir. So thank you so much for this brainstorming session and such lovely case studies. I think people are already have mentioned that they have learned a lot by each case study progressing. So, and anyway, sir, your sessions are always very brainstorming. I have myself attended a couple of them
Thank you. Thank you.
and looking forward for BCA sessions also.
Yeah.
So thank you,
Thanks.
sir. Thank you so much for your knowledge and inspiration always and your valuable insights.
Thank you. My privilege and pleasure. Thank you very much. Okay.
Thank you so much.
Sign off. Yeah.
Yes, sir. Sure.
Thank you.
Thank you, sir. Good night.
Right.